Good morning, everybody. Time to get going, I think. So the guest this week is Stephen Tredget of Oakley Capital Investments, who's been on the show before. So this is really catching up with what's been going on with that fund, but we'll do a quick recap of how it all works. But first of all, I'm going to do the this week's news. So there really was not a lot going on this week. It's kind of strange. I'm not quite sure why nobody was announcing anything, but a couple of things that I picked out. One is Greencoat Renewables, which wants to raise quite a lot of money. And the other is the new Fidelity Emerging, which is what was Genesis Emerging Markets. Greencoat first. Its NAV share price really relatively stable. The main moves that we've got here, it looks much more volatile than it really is because it's priced in euros, and so the currency moves affect it. But apart from that, it's still, I think it was issued at €1 and the NAV is about 101, as we'll see in a second. It's traded a pretty big premium to that pretty consistently, apart from obviously the little market wobble last year. And that's been allowing it to expand, and it wants to be quite aggressive in that. Here it is sitting within the sector. There's 19 funds here. Obviously, we were about to get a 20th with Blackfinch, but that's been pulled this week. It's one of the bits of news that we did have this week. So still 19 funds is quite a lot to be going on with. Blackfinch was going to be another competitor to Greencoat. And what I've done, here there's the returns. None of these things are 10 years old yet, so we haven't got 10-year numbers. But they're okay, but they're pulled down by currency moves. And these are the funds that are investing a large chunk of their assets in Europe, in renewable energy. Quite obviously, Downing, you'll know if you've read our notes, has put an awful lot of money into Sweden, and that seems to be quite a good move for it. And it's looking to raise some more money now. And one of the things I would like you to look out for, we're doing a webinar for them on Monday. So if you'd like to hear more about it, please do tune into that. Greencoat there, which is the largest of these funds, and then the Octopus Fund. So I said the point of this was to highlight the fact that it wants to raise a lot of money. Its placing program will allow it to issue 400 million shares over the coming year, starting off issuing shares at about €1.11. So decent premium to the NAV there. It's to pay for their pipeline, which is quite chunky, a lot of which has been committed already. They've got a revolving credit facility that allows them to sort of buy stuff ahead of raising new fresh equity, but they want to keep the debt relatively high anyway. That's just a function of these funds. Some of these funds is they see the relatively stable cash flows as a good way of giving those up to borrowed debt. It's 4 years old, targeting returns of just over 7% a year. It's very much a portfolio of Irish wind at the moment. It was really launched as a complement to Greencoat UK Wind. The Irish assets, the way the subsidies work, is slightly different to those in the UK. Really, effectively, it's done on a sort of floor price. So they get a minimum return for their power that they produce, which is great. It means it's a bit more so predictable even than the UK, where there's a quite high reliance on market power prices. But that guarantee is relatively short, 15 years. And I think Greencoat's got their first asset that's sort of rolling off that this year. So what they're going to do, because the Irish market, although they're still investing in it, it's looking relatively saturated for them. They're going to expand into wind and solar across Europe. They're also investing in some batteries. So they've got their first pilot project underway. And so there's a way of negating the problem of these things rolling off the fixed power prices. They're looking to secure long-term power price agreements in some sites. They see some opportunities in data centers because one of the things that Amazon, the people on the like would like us to do is to say, we choose you because we use renewable power to power our data centers. And so the Irish wind is not a bad way of doing that. And also, which is playing to some things we've been talking about recently, they also see opportunities in generating hydrogen as with their sort of spare electricity as a way of storage, storing power in the future. Its existing portfolio, as I say, almost overwhelmingly in Ireland, a bit in France, and one new project that they got last year in Finland, which is under construction. The reason that they need to keep investing is to tackle this chart here. So this is showing you how the contracted revenue, the sort of ad-supported revenue, rolls off by 2033. Then it's all about what they can generate from selling power in the market. And this is not unique to them. This is going to be a factor for a lot of these renewable energy funds, but for some of the UK subsidies last a bit longer than this. But it's something people have to bear in mind. So reinvesting the cash flow into new assets is important. Originally, they said they were going to look at Northern Europe, but they seem to be including Spain and Portugal in that now. So there's quite a lot of stuff that they could possibly invest in. So this sort of getting on for 450 million euros that they want to raise now, it's likely to not be the end of it. I think they're going to be coming back looking for more money. Most of that chunk is already committed. So there's the Finnish wind farm we talked about before. They're building 2 more Irish ones as well. I think this is just going to keep on growing, but it's obviously not the only one. And so I would like to see really all 4 of those European funds continue to expand. It just makes more sense to keep plowing away in different markets other than just the UK. Part of the reason for that is that diversity of power resource. Turned out that the last 6 months, or the 6-month period that they just reported on, the wind production was actually 11% under budget because just wind wasn't very strong in Ireland. That sort of thing. If you've got a mix of assets across different countries, is much less of a problem. So actually, what stuff I had in France was overproducing. So that balance is actually quite helpful. So that's Greencoat. Just briefly on Fidelity. So obviously was Genesis Emerging Markets. The name change actually got approved early this week. The vote, if you remember, we talked about this recently because the Genesis manager came out and said they thought that investors should be offered 100% exit price to NAV because it's such a big change to the mandate. And actually, there was quite a big vote against this move, as you can see there. The tender offer is for 25% of the fund. There's quite a high chance I think that's going to be oversubscribed. So it might start off by shrinking quite significantly. We will find out that on the 18th of October. 1.6 million shares were sort of dumped in the market on the 1st of October, which is quite a big trade for that fund. And that's pushed the discount out a little bit. So it's about 8.6% now. So I think we're going to see some gyrations in the stock just over the next few weeks. And if you're a believer in the Fidelity approach, this might be an opportune time to pick some up. Now it's managed by these two, Nick Price and Chris Tennant. Fidelity, as we know, has got a fairly big team with sort of boots on the ground in places like Shanghai and Mumbai, and obviously because they've got dedicated funds in those areas. This fund is sort of like a sort of go anywhere for returns fund. So part of the attraction for them of launching a trust is that they can invest in some smaller companies. They also want to put some unlisted exposure in there. I think this is one of the things that the Genesis lot were slightly unhappy about. But as we've seen it in lots of different markets, it can be a good source of added value. It's the normal kind of Fidelity approach to running money. So they're looking for companies that can generate high sustainable returns on capital with defensible business models and good management that are kind of aligned with shareholders. What makes it, again, slightly different is that it's going to be able to use derivatives, and they're actually going to actively do that quite a bit. And here we're looking at something that's a bit more akin to BlackRock Throckmorton model, but in addition to going short on individual stocks, they're also going to be taking additional long positions in stocks as well. So they're going to be sort of gearing up individual positions within the portfolio. And they're also, from time to time, going to be shorting whole markets with shorting indices. So there's a lot of different levers being pulled here. The idea of it, though, is that net, the gearing into the markets won't be too high. So where they take some gearing on top of a stock, there'll be a short somewhere else to slightly offset it. It's going to take a while to realign the portfolio to get there. So before we actually see what it looks like, several weeks, I think we're probably going to be looking at sort of like a end November fact sheet before we know what the position of the fund is. What we'll try and do is get them on the show here to explain how it all works, probably after that. Watch this space. So enough from me. As I say, there wasn't an awful lot this week.